You talk to your clients. How concerned are they about this? What do you tell them?
Well, David, in the last week, I've actually fielded a number of calls with clients, and some of them ask, why aren't more people talking about this on the investment front? So they're clearly concerned about the, tensions in Ukraine, which seem to be escalating, in addition to the concerns we've been talking about for months, like inflation and interest rates and slowing economic growth. So, they want to know if they need to do anything different in their portfolios. Do we need to change things for them? Or are they well positioned? And the answer to that comes down to really, what's their time frame? We've seen the world confront pandemics, wars, recessions. The stock market suffers for a while, but eventually recovers. So the time horizon for the investor really matters here, as well their risk tolerance for suffering through the volatility. So there are solutions out there, and the solution really depends on the individual investor.
Yeah, I agree with that, JoAnne. And in fact, when we think about geopolitical events, believe it or not, they tend to have very short-lived impact on the markets. What really matters is the larger ecosystem in which they're happening. So if we think about 9/11, terrible, terrible tragedy. Markets closed for 4 days. When they reopened the following week, you had a very significant sell-off, but within 2 months, that had actually been recovered. What was more important was the ecosystem that happened in. We were already in a bear market from the tech bubble bursting, and that market continued for a couple of years. I think the other thing that is important when you're thinking about war is, wars take time, right? We've learned that as a country. They take time. They can really impact your fiscal budget for a very long time.
Well, part of the ecosystem, though, Catherine, I wonder, is just volatility. We already had volatility because of the uncertainty about the Fed, triggered by the inflation and other factors. So putting more volatility into that, more uncertainty, what does that do to you as an investor? How do you deal with that kind of volatility going forward, Catherine?
So JoAnne said it right. Time horizon matters, and for most investors, their time horizon is actually quite long. They're saving for their retirement or maybe even their children and grandchildren. And so you can withstand volatility if your time horizon is long. The other thing I would say about volatility is, when we come out of a recession and a bear market, as we did over the last 2 years, those early months and years, everything goes in the same direction. It goes up. You don't have the normal volatility, and we haven't. But in fact, when you look at the S&P 500, the average intra-year correction over time is 14%. And yet 70% of the time, the market ends up by the end of the year. Yeah. So this is normal volatility. It just may not feel that way right now.
JoAnne, actually, Catherine just talked about a bear market. Is it possible we are entering into a bear market right now?
Well, in some areas of the stock market, we're already in a bear market. Right, look at infotech, look at other areas of growth, some areas of consumer discretionary communication services. A lot of these stocks have come down, well more than 10%. And their multiples have come down accordingly. And that started before really the Ukraine tensions really heated up. And it was primarily triggered by the Fed signaling that they were going to be raising rates and when rates actually rose. But, back to Catherine's point on the environment in which this higher risk has now arrived. We are the U.S. economy and the global economy still in the midst of a recovery from the worst of the pandemic. So we have a backdrop of production increasing, whether it's in industrials, consumer products, housing market, right? And these are all trends that are likely to continue despite what is happening in the Ukraine, because there's more and more production coming online. Cars, for example, have really been held back, and that should ease in the back half of the year, for example, as semiconductor production. New factories come online starting in the middle of this year. So the economic environment is actually fairly positive. We worry, though, right, about the Ukraine situation and how the sanctions that may end up being triggered if this really goes forward will affect particularly the European economy.
Yeah, we would agree with that. And we remind ourselves about the business cycle that we were in when this global pandemic hit. We were actually in an expansionary cycle. It was the longest one on record. Companies were strong, consumers were strong. We got interrupted with this terrible, terrible health crisis. But coming out of it, as JoAnne says, the global economy is growing. It may not be growing as fast this year as it was last year, but it's going to still be nice growth. We expect 4% or so in the U.S. this year.
Catherine, I'm curious, going back in history, sanctions. We just heard JoAnne refer to sanctions. We had back and forth and up and down all week long, and at the very end of the week, President Biden came out and said that he believes, based on intelligence, that President Putin has actually decided to invade. Let's assume that's right. Let's assume that's right, and sanctions do come. In the past, what has that done to an economy and to businesses? How do you take that into account?
So for the global financial system, the impact of sanctions really depends on the size of the countries and their size in the global economy. And in this case, Russia and Ukraine are actually relatively small in the scale of the global economy. That doesn't mean, however, that sanctions on Russia wouldn't have couldn't have a very severe impact on Russia and its citizens and economy.
And also, right, the impact, even though Europe is voluntarily going to impose these sanctions, it's going to hurt the European economies. And I think that's probably the bigger risk. And, that's why you maybe want to be a little bit careful about some European exposure at this point.
Does it affect the length that you want to go? Do you want it to affect basically how long you want to invest for? Liquidity, do you need to be pretty liquid, JoAnne?
Yeah, really depends on the investor. If they need liquidity in the relatively short term, then they probably want to be there already, right? So, if I'm talking to a client who's in our balance strategy and they're 70-30 and they know they're going to have some expenses coming up and they were just planning on selling stocks 6 months from now, they should probably be a little bit more conservative. And that fixed income, even though we're not expecting a lot out of the fixed income world, if you hand select bonds and preferreds, you can protect against some of the risks from rising rates, lock in some income and still be liquid. So if the time horizon dictates that you're going to need liquidity, you ought to be positioned for that now.
Catherine, do you have clients going to cash or the cash equivalents?
Not really. Not really. When you think about liquidity needs for people, April 15th is a liquidity need, right? So we see people planning for that need every single year. We see it now, but no, we don't see clients going to cash because if you're a long-term investor, you need to stay invested. The market path is gently sloping upwards over time, despite these volatile periods in between.